fundsupermart.com.
What is your outlook on global equities in the next 1 to 2 years?
The moment our outlook for global equities is one of caution. Global equities have been pretty strong for the last several years. The MSCI World, for example, is up 85% in US dollar terms since the beginning of 2009. And we just have some concerns over how much of that has been driven by quantitative easing, particularly in areas like the United States, Europe and Japan. And how much of it has been driven by the underlying fundamentals of the companies, which we don't necessarily believe warrant the move that we've seen in markets. So, for example, earnings growth being negative in some parts of the globe, we think that warrants caution. Also, more recently, we've seen some geopolitical uncertainties in certain parts of the globe, which always has the potential to rear its head again and brings uncertainty, weakness, and potential volatility. So, given the strength that we've seen in markets these last few years, given the environment that we currently find ourselves in, we think that global markets warrant caution at this moment in time.
How should investors position their portfolio in light of benign inflation and impending rising rates?
Well, benign inflation or even deflation has obviously not historically been the best environment for equities. Other asset classes traditionally fare better in that environment. And being an equity fund manager, what we're focused on with regards to benign inflation or deflation is just to focus on companies that have sizable market shares and high barriers to entries in terms of the industries in which they operate. And also companies that have got very, very strong balance sheets and strong dividends and strong cash flows tend to fare better in that sort of environment. Also companies that tend to be more focused on defensive areas of the market, so some consumer staples, for example, again tend to fare better in a sort of benign inflationary environment. So if we are to see that sort of environment continue in terms of equity exposure, those are the names that we would be looking to. In terms of rising rates, obviously many companies have been taking on quite a lot of debt these last few years. Rates have been low, abnormally low, some people would argue, these last few years. And when rates do eventually increase, the concern could be that some companies may well have overstretched themselves in terms of their ability to service and ultimately pay back that debt. So avoiding companies that are too heavily indebted would again be a focus of ours anyway, regardless of the economic environment. But certainly once we see a move on rates globally, that will certainly become a focus, we believe.
Emerging markets are sporting more attractive valuations than developed markets. How do you think this will influence the way emerging markets move in the next 1 to 2 years?
Yes, certainly they look attractive to us relative to developed markets at this moment in time, particularly on a price to book basis. What will drive markets, emerging markets, over the next couple of years? We still think they will be influenced by obviously investor sentiment and ultimately capital flows. But this year the focus has certainly been on one of elections. Over 40% of the world's population are having votes this year. And now that we're more than halfway through the process, it has been politicians and parties with more orthodox or market-friendly policies that have done better. So reform could play a huge part going forward. In terms of the corporates, there has been a difficult couple of years for emerging markets. We've seen margins compressing a little bit. We've seen the top line growth coming in a little bit, and that's obviously had an impact on overall return on equity. But in the very recent past, we have seen a tick up in the top line and even down to the operating income level. So if we see that continue, given the relative valuation attraction at this point, we think that it could be, coupled with reform, quite a positive time for emerging markets. But again, investor sentiment and also capital flows will also play a part.
Geopolitical risks have subsided a bit for now, but they could flare up again. What do you make of this, and what will be the impact on global equities?
It's an interesting question. They've subsided a bit, for now, but they could come back in the future. And the honest answer is that nobody knows if and when and where these things are going to arise. For the long-term investor, which is what we really focus on, any sort of tick up in geopolitical uncertainty, you know, brings volatility and potentially weakness, and that for a long-term investor is potential opportunity. Trying to second guess where these things will happen is not what we get involved in, but as long as it doesn't directly affect any of the companies, then potentially there is opportunity there for someone with a longer term, you know, investment time horizon in mind.
Do you think it is important to focus on income when seeking global equity exposure?
Yeah, I mean, when you look at long-run equity returns, you know, the amount of capital return that comes from the reinvestment of dividend income over the years makes up a huge percentage of it. When we look at companies, you know, we like to see companies that pay dividends. It lets us know that, you know, management are interested in looking after our clients as minority shareholders in that business. It also lets us know that if they manage a dividend program, you know, that takes a degree of capital discipline. So it is something that we look for in companies, as well as just looking at absolute levels of yield. You know, looking at 3 and 5 year historic dividend growth numbers. If they are, you know, substantially in double-digit territory, then it does give us some degree of comfort with the, you know, the financial strength of that business going forward. So we think dividends do play a big part. It is something that we look for, again, regardless of the economic environment, because over the long term it can play and does play a substantial part in the overall return to our clients.